Good afternoon. This is Brad Dennis with BIS Commodities with your weekly wrap-up on the grain and financial markets. We're looking at, this is the July 4th or Independence Day week wrap-up. Shortened week. Thursday had a day off. We had regular trading hours today. And so with a shortened week, you're looking at lighter volumes out there. And today was an attribute to the holiday shortened week, and trade volumes were very thin. Still in the corn and bean market, we're still talking about two very different crops. Not corn and beans, but old crop, new crop. Old crop basis, still very strong out here, and you're seeing a lot of the bull spreading going on, and that bull spreading is really pressuring both new crop corn and new crop beans. New crop beans down over 20 cents today, and new crop corn down at its lowest level or its lowest close since 2011. So once again, you're looking at July, tight supplies. We're seeing a lot of the commercials basing their bids now off of September. You only have a week left on July's, so September should start to get pulled up somewhat. Not necessarily go to those July levels, but it should probably be pulled up here in the next couple weeks. A lot of interest in the September-December corn spread. Same with August beans. August-November bean spread will get a lot of play here over the next couple weeks as well. Technically, in the December corn, we're looking at a bearish setup. You took out 511 last week, which was support from 2012. During the week, this week, we tried to go back up above it, couldn't, so what was once support is now resistance, and we continue to see lower lows and lower highs on the charts. You got to sit back and you got to say, all right, well, who is buying this right now? Well, the end user is looking at a very large crop coming out. And with those new crop supplies, they've been hand-to-mouth for so long that they're very reluctant to forward price anything right now, until it really comes down to some very attractive numbers. The money is not looking to buy this thing right now. You know, you've got Bernanke talking about tapering, all the numbers that are coming in, such as non-farm payrolls, which we'll talk about a little bit later, talk about an improving economy, so the tapering out of the Fed looks to be taking effect in September. So you don't have the end user, and you don't have the money manager coming in and buying this thing. On the sell side, you don't have the producer selling it right now. I mean, he's looking at $7 for his old crop corn. Why the heck would he be selling something under $5? Very hard for him to do. So he's staying out of the game, hoping there's some kind of weather-related rally. The only guy that is selling this thing is the aforementioned technical trader. Like I said, lower lows, lower highs. We're taking out moving averages on the way down. That's causing him to build up a short position. What reverses that? Well, right now the nearest reversal level is that 511 level. The other side of the coin, though, is if we do come into some kind of weather issue, maybe those fundamentals out-trump the technicals and cause the technical traders to take some money off the table, or we are able to rally this thing enough to get over those technical levels. Weather-wise, though, right now, not an issue with corn and beans. You're looking at, some heat that's supposed to be coming in to the western corn belt next week, but that's accompanied with rains. There is a little bit of concern of the 6 to 10 day, and that would be next weekend. We'll see some heat come in as well, a little bit of ridging, but it backs off back to the Four Corners where they've had 126 degree heat in Death Valley. So there is some heat that's coming in, but it's accompanied with rains, and then it comes back in and it's very short-lived. So really not a threatening weather pattern as of yet. There is a prominent meteorologist that's trying to say that towards the end of July, we'll probably start to see a drying trend. So a lot of people are waiting to see if that forecast comes through or not. Wheat, touch on that just briefly. This past week we've seen some wheat sales to China, and we'll probably see more to come. The wheat market has not bottomed out, but is starting to create a basing pattern down here. So if we can get the wheat market to create a little bit of a base here, maybe we can see this corn stop dropping by a dime plus a day. Traders expect the crop ratings on Monday to improve or to advance. So with that in mind, you're going to be putting in higher good to excellent ratings for both corn and beans going into next week. The real important part will be Sunday night, and we'll see what the update on that 6 to 10 day is going to be. Remember, everybody's looking at the end of July to be our pollination time frame, and those are the weather models that really interest most of the people. Over in the S&P, we're seeing a slight rally back. It's about 120 here on Friday, so we're seeing the S&P having been up to 1630 come back down to about 1610, and now we're trading about 16020 or so, right in the middle of the range. We had non-farm payrolls come out today. They were a lot higher than what was expected. Everybody was looking at 175. Increase on the non-farm payrolls, it was up 195. So when we saw that first increase at 7:30 this morning, we saw a little bit of a bid come into the market. Then at 8:30, when stocks opened up, we saw it come back, with the thought being that, hey, better jobless or better more jobs out there than expected. We're going to see more confidence in the Fed tapering back their bond purchases. So we traded that for the first half. Then you look into this job report. The unemployment rates held steady at 7.6%. But you look at those jobs created, and there are a lot of part-time or seasonal jobs, it looks like. So how stable is that number? And I think that looking into those numbers a little closer has caused this afternoon rally a little bit. With the stock market rallying, though, and with still a pretty good possibility of bond tapering by September, we're seeing the dollar rally substantially. And we're at yearly highs for the dollar index right now, and that's also kind of putting some pressure on our grain markets as well. We were before, expensive with our grains on the export market, and now we're even more expensive because of the higher dollar. All our competition is kind of undercutting our prices somewhat. The other thing that's propelling the dollar up there is not only the possibility of tapering, but it's a safe haven play. We have a situation over in Egypt that is getting more combustible by the moment, and today we're hearing about some violence over there after the military's 48 hours came up. So you're looking at a very unstable situation in Egypt, and with it being the Middle East, we're seeing crude oil run up, and we were up $1.50 as of last check on the crude oil. Now, it's not so much that Egypt is producing crude oil, but they control the Suez Canal. Another factor in these higher energy prices has to come from all the floods that we've seen up in Canada. There's been a lot of shutdowns in Canada trying to get oil down to the U.S. So that's why we're seeing a little bit of a bid out there as well. The flooding issue will, rectify itself, and we'll probably be back to normal flow here in a week or two. But as far as the Egyptian protesters and the violence going on over there, that's going to stick around for a little while, and we really don't see any true outcome in the near future. So Heading forward for the next week, couple things to keep in mind. It is all about weather. We've gotten through the quarterly stocks. We know what the government thinks on that. So we're looking at weather. We're going to have the USDA's supply and demand report next week. And remember, we've got to go off the acres that they showed us the other days off of the quarterly stocks report. So that probably will not be a big deal. Everybody kind of knows what to expect there. What they're anticipating, though, is that August supply and demand report, and that's the first time we'll get the crop surveys from the estimates or the surveyors going out into the crops and doing a little bit more intense survey of where we are at yield-wise and such. And then as far as the rest of the month, like I said, we're probably having more emphasis on the August supply and demand report rather than the one that's going to happen next week. So if that's the case, we have a little bit of a negative attitude for the month of July on these markets. So next point, technically, when you're looking at December corn, you're probably looking around that 475 area. There could be some orders lying down there, more aggressive orders, I'd say. Whereas in the beans, we traded through 1230 today, so the next actually level is the 1210 area. We'll see if that's supportive. So that is where we're at for the week. Look at it as two different crops. You're going to hold your value in your old crop, corn and beans, but the new crop corn and beans will continue to have some pressure as long as they're one bear spreading it to crop conditions continue to improve. So that is all I have for now. So have a great week. End of broadcast.